Okay, the ANZ quarterly yesterday. Look, I was pitching a lower growth scenario than where consensus is. The quarterly looks like the business is tracking broadly in line with that consensus number. So if I just touch on some of the key points, loan growth above system. So they're really hammering it on that front. In one quarter, they've basically done the equivalent of what I'd factored in for the half year, and that's almost entirely in the home loan segment. They say that they are not at market-leading pricing. A part of it is really to do with servicing brokers, et cetera, and the speed of turnaround. Revenues in line with the PCP, so I had a bit of a decline. Unfortunately, there's no detail on whether it's a NIM being stronger or whether there's other operating income in there that's holding up the revenues. No data on cost, but they do say that the cost inflation that's coming through is mostly being offset by cost out initiatives. Credit risk, which is to me like a real key thing coming through on these quarterlies, is very good. The loan loss expense is just way below what's baked into consensus expectations, and even the write-offs are trending down. So the credit environment is just very, very strong. Regulatory capital, look, it's a bit less than what I was expecting, but I think that's partly because of the growth being stronger. And even after allowing for the capital they might have to spend on the Suncorp Bank acquisition, the CET1 ratio is above their 11 to 11.5% target. So even on that front, they've got capacity to do a buyback. So overall, a good quarterly. The big decision we're all waiting on is the Australian Competition Tribunal decision on whether ANZ can acquire Suncorp Bank. So that's ANZ. Transurban, look, stock trading, mid 4% based on unchanged FY24 DPS guidance. If you think about revenues on the toll escalation side, like the majority CPI linked, so they've been getting the benefit of the high inflationary environment. But if I can borrow a phrase from Star Wars, I think there's disturbance in the force. And look, what's going on here is traffic growth is really like a key value driver for the business. But in two of their key markets, Melbourne and Sydney, you can really sort of see how there's weakness in that traffic, and it's uncertain about where the sort of steady state is going to end up. What's going on here is in both regions, there's construction projects underway that is disturbing the traffic flows. And then there's also new capacity that's already opened up in Sydney with the opening of WestConnex, and there will be when Transurban opens up its Westgate Tunnel project at the end of 2025 in Melbourne. And both of those things are also going to disturb the traffic flows, and not just the traffic flows, but also the mix and the distribution of traffic, which also drives the average revenue per trip. So it's going to be a bit of a unsettled 2 to 3 years in my mind in terms of just where we're going to end up with that steady state number, which is really where we can then peg out a traffic growth to over time. So what else have we got going on with Transurban? Cost guidance that they gave is pretty much come on down a little bit, but there wasn't very much growth at all in costs in the first half, which means it's all skewed to the second half, which then has a bigger impact flowing through into subsequent periods. Interest costs, even though they declined a little bit in the period, over time they will increase. They will increase because of refinancing at higher interest rates, and also because as these construction projects that I'm referencing come online, the interest costs that are being capitalised from an accounting perspective become expensed, and that causes a big step change. And then the other thing sitting out there is corporate tax. They haven't been paying any at the corporate level. Look, that's been pushed out by 1 year to FY27, but it is out there, and that will have an impact on sort of the medium-term cash flow growth. So, look, I'm forecasting about a mid-single-digit CAGR in terms of distribution growth over the next sort of 3 to 5 years beyond FY24. So, certainly not the superstar sort of stellar sort of sort of teen compound growth in distributions that were coming through in yesteryear. Target price $12.30, got a whole recommendation on that. And then Horizon yesterday, look, I think the thesis there of a step change in the distribution and or a buyback coming online, that's very much there, fast approaching. The balance sheet management were very confident in talking about how the key credit metrics are likely to be restored by the end of this financial year, so June. So with the earnings growth and just going from 75% to 85% payout, I'm targeting a 25% increase in the dividend. It could very well be that they go back to 100% payout. That's where they were before they bought One Rail. and that would obviously see a far greater increase in the distribution. So on my forecast at current prices, you're getting a yield at the moment of in the high fours. With that 25% growth, you're getting it in around about sort of 6% yield, and you should be thinking around about, I think, sort of 60% franking of that dividend also. On the result, look, on the face of it, looked absolutely stellar when you first looked at it, and it was very much a solid beat of expectations. But there's a lot of moving parts going on with this business, and you need to put it in the context of an unchanged FY24 EBITDA guidance. Now, we might have moved within the range, but certainly that guidance is unchanged. It needs to think why. If I can sort of take you through bits of the business, the network business, 57% EBITDA contribution from that part of the business. All of the outperformance is to do with over recovery of regulated revenues, which underneath the regulatory regime, they've actually got to hand back to customers in 2 years' time. So NPV equals zero. Coal was way better than expected, and that was to do with their revenue yield increases. They have basically guided that revenue yield will actually decline in the second half, particularly as BMA starts to ramp back up its volumes in the Goonyella system. Bulk was disappointing. They put a lot of capital into that segment, and it still hasn't quite yet really got going and getting people excited. But they referenced they've won 2 new iron ore contracts on the Darwin to Adelaide Railway, and that is a significant earnings driver for coming periods. So that should give that a bit of a kick. And then the final sort of pillar of growth for them is the containerized freight segment. Now, that was an EBITDA drag. They've been ramping up their scheduled services, both north-south and east-west. That should be fully ramped up by April this year, so as you can understand, the costs come before the revenues. So they're basically saying that for the full year, there should be immaterial negative EBITDA contribution from the business on a full year basis. I think in the first half there was a reasonable EBITDA drag. So that sort of segment over the coming years should actually really start to increase, particularly with that toll contract they won that's underwriting that the expansion to that segment. So overall, if you look at my numbers, I've got a 7% upgrade to FY24 NPAT, and I've got just about an equivalent decline to FY26 NPAT, with most of that sort of variability getting driven through by the network business. So with that pretty much immaterial NPV result, target price is $3.75. That's up 1 cent. I've also got a hold on that.